Looking for a stock with a yield that's more than twice as high as what the broader market offers? Want safe dividend growth to go along with that yield? Like the idea of being invested in a service that people can't live without? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a utility providing electricity to millions of customers. There are a lot of products and services out there that we can all live without, but electricity, not one of them. Because of the inherent need for power, utilities have built-in demand and profits. That also means built-in dividends. And as more people consume more power at higher prices, you get bigger dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Pinnacle West Capital Corporation, which appear to be trading at a significant discount today. Pinnacle West Capital Corporation, stock ticker PNW, is a utility holding company that principally serves as the parent of Arizona Public Service, Arizona's largest and longest serving electric utility. With corporate roots dating back to over 125 years ago, Pinnacle West is now a $9 billion by market cap utility whopper that serves more than 1 million customers. The company's one reportable segment is their regulated electricity segment, which consists of traditional regulated retail and wholesale electricity businesses engaged in electricity generation, transmission, and distribution. Residential customers accounted for 50% of fiscal year 2020 electric revenue, while industrial and commercial customers accounted for 49%. Other revenue occurred through wholesale, transmission for others, and miscellaneous customers. APS is vertically integrated, providing retail or wholesale electric service to almost the entire state of Arizona, that is, except the Metro Tucson area and about half of the Metro Phoenix area. Fuel sources for APS for 2020 were as follows: gas 28%, nuclear 23%, demand side management 16%, coal 14%, renewables 11%, and purchase power 8%. A significant portion of the company's energy mix comes from clean sources. Moreover, they've announced a plan to deliver 100% clean, carbon-free electricity by 2050. The investment thesis regarding a utility business like Pinnacle West is very straightforward. In a modern-day society that quite simply cannot function without reliable access to power, Pinnacle West provides a service that practically sells itself. They have captive customers that really can't live without the service. This inherent need creates unflinching demand and a built-in profit source. That profit, of course, leads to dividends, and as more people move to Arizona and demand power at higher prices, you get higher profit and more dividends. Pinnacle West has already increased its dividend for 10 consecutive years. The 10-year dividend growth rate is 5.8%. That dividend growth rate beats inflation and is rather nice when you layer that on top of the stock's current market-smashing yield of 4%. This yield doesn't just cream the market, by the way, it's also 60 basis points higher than the stock's own 5-year average yield. And with a payout ratio of 67.5%, this is a well-protected dividend. Looking at business growth, Pinnacle West has increased its revenue from $3.241 billion in fiscal year 2011 to $3.587 billion in fiscal year 2020. That's a compound annual growth rate of 1.13%. Meantime, earnings per share grew from $3.09 to $4.87 over this period, which is a compound annual growth rate of 5.18%. These are fairly standard numbers for a utility business in my view. I see them as neither excellent nor subpar. However, there's been a very recent explosion of demand for Arizona in general and Phoenix specifically. Migration to this area bodes well for the utility with a good chance of growth acceleration off of this already solid base. Looking forward, CFRA believes that Pinnacle West will compound its earnings per share at an annual rate of 5% over the next 3 years. So CFRA is basically assuming the status quo here, which is fair. I'm a bit more sanguine owing to what I just noted about Arizona's recent in-migration. Even if CFRA's growth forecast were to materialize, which would be in line with Pinnacle West has historically delivered, that would be enough bottom line growth to fuel similar dividend growth. And when you pair that kind of dividend growth with the 4% yield, I think that's right in the wheelhouse for a utility investor. That said, I do believe there's a good chance that both earnings per share and the dividend will eclipse this 5% growth level when peering into the near future. Moving over to the balance sheet, Pinnacle West has a pretty standard financial position for a utility business. The long-term debt-to-equity ratio is 1.12, while the interest coverage ratio is near 4. Profitability is robust, with margins standing out as a strong suit. Over the last 5 years, the firm has averaged annual net margin of 14.31% and annual return on equity of 9.96%. I see Pinnacle West as a very good utility business across the board. What's particularly exciting about it, in my opinion, is the area in which it operates. I'm enthusiastic about Arizona in general, and Pinnacle West should see that rising tide lifting its boat. The utility also benefits from competitive advantages that include economies of scale, geographic monopoly, and a regulatory structure that nearly guarantees profit. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Regulation is a double-edged sword here. On one hand, regulators allow for utilities to make a reasonable profit, factoring in things like capex. Profit tends to scale with costs. This puts a profit floor in place for the business. On the other hand, there's also a ceiling because power is necessary, and there's often only one power provider in any one geographic area. Regulators limit the rates the utility can charge. Since a geographic monopoly is often in place, competition is, in the traditional sense, is usually nil. However, customers could become greater competition in the future through the generation of power at the site of consumption. There's also geographic risk here. Utilities don't have the ability to expand their coverage areas very much, so they largely rely on the underlying population growth of those areas. I also see pricing risk. The company purchases some of their power. This leaves them vulnerable to swings in natural gas prices. Lastly, there's nuclear risk. Pinnacle West has an interest in the Palo Verde nuclear plant, the largest nuclear plant in the United States. Even with these issues out in the open, I still believe that the potential long-term reward easily outweighs the long-term risks. And at the right valuation, that equation skews even more to the investor's favor. With the stock price below where it was before the pandemic, despite all of the growth over the last 18 months, I see the valuation as attractive. The stock's price-earnings ratio is 17. That compares very favorably to the market's earnings multiple. It's also well below the stock's own 5-year average price-earnings ratio of 18.7, and the yield, as noted earlier, is measurably higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate to account for the higher yield and a long-term dividend growth rate of 5%. This is extra conservative. I'm basically assuming, like CFRA, more of the same. It's status quo. This dividend growth rate is right in the same neighborhood as the company's 10-year earnings per share compound annual growth rate and the 10-year demonstrated dividend growth rate, and it matches CFRA's near-term earnings per share growth forecast. I think Pinnacle West could easily outperform this expectation. As always, though, I do prefer to err on the side of caution when extrapolating projections out over a very long period of time. The dividend discount model analysis gives me a fair value of $87.15. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all of the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Pinnacle West as a 3-star stock with a fair value estimate of $88. CFRA rates Pinnacle West as a 4-star buy with a 12-month target price of $92. We're all in the same ballpark. Averaging the three numbers out gives us a final valuation of $89.05, which would indicate the stock is possibly 7% undervalued. Here's the bottom line, guys. Pinnacle West Capital Corporation is a well-rounded utility business that's situated in one of the best markets in the United States. It's an appealing business operating in an appealing market, and it's trading for an appealing valuation. With a market-smashing 4% yield, inflation-beating dividend growth, a decade straight of dividend increases, and the potential that shares are 7% undervalued, this is one of my better current ideas for dividend growth investors aiming for yield. And now for a special news announcement. Microsoft Corporation, stock ticker MSFT, got some bad news recently. The U.S. Department of Defense canceled the lucrative $10 billion Jedi cloud contract due to a dispute, a contract that Microsoft had previously won. No matter. The stock barely budged on the news. It's currently sitting at its all-time high, and the Department of Defense announced the Joint Warfighter Cloud capability, a new multi-vendor cloud contract in lieu of the JEDI contract. We highlighted Microsoft as an undervalued opportunity back in April when the stock was around $250 a share. It's now at $280 a share. This is a machine. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.